What's the opposite of astonished?
Road bike. You know the ones they've got in Giro, the curved ones. I bought one of those.
Amazing. Yeah, I love the titanium.
Things are going well on Team Hughes. Things are going well on Team Hughes.
I know, absolutely.
Not as well as a Team Ray.
No,
Less said about Team Henry, the better. Shall we?
Back on holiday. I'm tanned, aren't you?
Emma, welcome. Thank you.
Great to be here.
Episode 11 of Taking Stock After the Bell. It's a wee bit of a tight squeeze today, but we don't mind that, do we?
Okay.
Emma Mogford is the fund manager of the Premier Miton Monthly Income Fund, as well as the Premier Miton Optimum Income Fund. You joined Premier Miton in November 2020 from Newton, where you're the lead manager on the BNY Mellon UK Income Fund, and also worked on the Newton Global Income Strategy and the BNY Mellon Continental European Fund. Emma is also a CFA charter holder. Neither Hughesy nor I are CFA, so if you just want to talk between the two of you for the rest of the show.
CFA cornered over here.
Well, we did discuss me doing my CFA this week, and you sent me a winky smiley face, and then a thumbs down.
I thought that was. I mean, we've got this little group chat. I thought that was slightly passive aggressive from Johnny. You two morons want to tackle the CFA? Okay, subtle wink and a nod.
No comment.
How are you keeping? Good?
Yeah, very well, thank you. Yeah, thanks for having me.
How is life in UK equity income land?
Yeah, no, well, it's all right. I mean, we had a good year last year. 2022 was good for UK markets relative to other markets, albeit there was a hard index to beat. I think 88% of fund managers struggled to keep up with the FTSE All-Share, and I was one of the few that managed to do a bit better. So that was nice.
Kudos to you.
And yeah, very happy to be running the fund at Premier Miton. Very excited about the future. So
brilliant.
Good stuff.
And tell me, just before we get into UK equities, because that's what we're going to do something a little bit different today. Usually we jump around the houses a little bit, but given we've got an actual real life UK equity fund manager, we thought we'd do a little bit of a deep dive in UK stocks. Tell me a little bit about how you sort of got into fund management originally and
yeah.
Your
well,
background.
I started with a degree in zoology. A dissertation on the intelligence of rooks relative to chimpanzees. You know, the kind of natural path into finance. But look, I was really interested in world news and global politics, and did some work experience, and I just thought, wow, this is really fascinating. And so when I got the opportunity to join Neptune as an analyst, I thought, great. I'll go and I'll learn, and maybe at some point I'll decide I want to, do something else, and just loved it. I kind of thought, I'll do this until I work out what I want to do when I'm older, and then it just suddenly dawned on me that this was exactly what I wanted to do when I was older.
What was that? So it was rooks versus chimpanzees?
Yeah, exactly.
What's a rook?
Oh, sorry, like a crow, like in the corvid family, like jays and magpies, and it's just they're big blackbirds.
Amazing. And
they pair bond for life, and they're very good at this was looking at tool use, so I gave them lots of Smarties packets that they had to get into, and anyway, so precursors for tool use.
This is absolutely
it's off topic, but
sorry, can we stay on this for the next half an hour? This is fantastic.
Well, we've got Johnny's a farmer as well, so I'm sure he can add some colour to
something. I mean, I guess you could sort of look at the animal kingdom and sort of have some crossover to market participants and how they deal with emotions of day-to-day markets. Behavioural angle here. But.
No, but I genuinely do love that. I sort of did experimental psychology in year 2 of my degree, and I think the psychology of markets is fascinating, but also how we as fund managers can control our biases, and we've got a number of disciplines that we use on the fund to make better investment decisions, and I'm very passionate about that.
Behavioural biases and sort of learnings from young and just experiences. It's hard work to sit there and think outside the box sometimes, isn't it?
Yeah.
And try and steer yourself away from what you feel comfortable with.
Yeah. Yeah. And good investment decisions are often uncomfortable ones.
Definitely.
It's when it's out of favour, it's when the
Yeah.
market's saying it's unloved, it's when the news flow is negative, and that's the valuation opportunity in my world anyway. So it's
Absolutely. We're gonna get on a wee bit on that because I wanted to pull on that particular thread. But before we do, UK stocks, you've sent us over a couple of charts if we just want to touch on these first.
Yeah.
So this is the valuation of the UK market relative to the States, which I think put together from FactSet, John.
FactSet, yeah.
Historically wide discount at the moment.
Yeah, exactly. And I think a lot of people talk about the UK being cheap, but they sort of miss how cheap. So today, the PE of the UK market is around 10 times, and the US market is 19 times. And so, UK stocks are basically half the price of US stocks. And then, let's not forget that discount was as little as 6% back in 2016. So, this is a relatively recent...
Was it?
Yeah. You can see on the chart that the kind of gap was much smaller. That's 6%, and the gap today is nearly 50%. And it's essentially an investor saying, I am willing to pay twice as much for $1 of earnings for a company listed in the US as I am for a company listed in the UK, and that to me just can't, it can't be right. And I think we can talk about it, a number of factors why that is the case, but for me it's a very, very compelling valuation opportunity. And it's also worth reminding ourselves that when we talk about US, we're also talking about global funds, because the MSCI kind of world benchmark is about 70% US equities. So we're making a really stark contrast between what the average stock in the world benchmark is and the UK.
Yeah. In terms of probably the effect of this is going to come out a wee bit as we move forwards, given what oil prices and things are doing. But how much of the earnings side of the equation in the UK has been inflated, I suppose, is the word to use, by rising commodity prices? We've obviously got quite a resource heavy type index. Is that a fair comment?
Yeah, I think that that's certainly right, and that has boosted. So you've got energy making up around 10% of the UK market. You've got miners making up maybe another 7%, and no doubt their earnings have been strong in the last year or two. But I think actually you see that gap starting to widen before that came in, and
Yes.
we're only talking about 17-20% of the index being kind of directly related. So I think there's more to the discount than.
I think I've seen some analysis from Schroders, and unfortunately we don't have it. But if you X out the sector composition differences, i.e. resources versus tech, on a stock for stock on a sector for sector basis, the UK market is about 25% cheap.
Yeah.
Versus the US.
I've seen the same analysis. Yeah.
I mean, you must if you go back to 2016. 2015. I mean, we won't mention the B word again. I mean, Microsoft, as an example, was probably on a PE of, was that 12, 13 times back then? Or was that slightly before that?
Yeah.
But we've had a massive amount of...
Apple was on 12 times in those days.
Yeah, we've had a massive amount of PE expansion from the big companies. It's not just the big companies; it's across the board. And we talk about it a lot in terms of the S&P being a different construction. It's full of slightly different businesses to the UK. But as Emma said, if if you're comparing like-for-like businesses within the same sector, there are still massive differences.
Even Shell versus Exxon.
Exactly.
Shell's a massive discount today. It's about a third.
Not to ask the bleedingly obvious question, but why is that discount?
That's definitely pointed at Emma.
Stony Valley.
If you've got like Shell and Exxon are cracking, maybe Exxon because you've got, they're anti-ESG, aren't they? There's probably a little bit of an overhang there.
Go with Chevron.
Shell and Chevron.
Yeah.
Oil companies, global, pretty similar businesses,
Yeah.
but there's a discount there. Why?
Why a 40% discount? Yeah, no, I agree, and you can see it in lots of different sectors. I think we can talk about kind of how it's come about. I think the Brexit vote and politics. Not just Brexit actually. I think it was it was Corbyn, and it was other kind of political instability that have sort of put off global investors. I think it's been outflows from UK equities.
We've got this charts.
Yeah, which we were going to come look at, which so this is showing retail ownership of my sector, the UK equity income sector, which has fallen to a third of its level, or a third of where it was a decade ago. But I think more importantly has also been the institutional allocation, and so we know that the likes of pension funds and insurance companies have reduced their allocation to UK equities from 50% to just 4% today. So there's been a lot of selling of UK equities, and that's pushed the valuation down. I think maybe it was also worth touching on the kind of the chart in between, which is looking at the UK's underperformance in the sort of decade plus since the GFC, and how that looks relative to interest rates. So what we know is post GFC we've been in this ultra low interest rate environment until recently, and that was a time when US stocks did much better than UK stocks. And I think it's it's not a coincidence that lower interest rates led to higher valuations for growth companies with a growth bias, companies that were doing buybacks, and that has favoured the US, and particularly the kind of large cap US. But the reason I've drawn this chart going back to 1997 is to look at the decade pre the GFC and remind people that actually in that environment the UK outperformed the US, and we've kind of all forgotten that the UK market could outperform kind of
like a long time
meaningfully.
James had hair in it.
True fact.
And in that decade, interest rates were an average of 5%. So maybe if we're going back to a more normal interest rate environment, then actually you want to be looking beyond the sort of characteristics that did well.
You do see that we went through an exercise last year of divvying up market returns, UK market returns and international stock returns by periods when inflation is going up and when it's falling.
Okay.
And what you see is during periods when inflation is going up, UK outperforms pretty materially. It's almost what tends to matter more than the absolute level of inflation is the direction of travel.
Okay.
Probably tallies back to this. It's a similar sort of thing. I suppose
The noughties were a decade of pretty firm inflation, wasn't it? And pretty high interest rates, so that all kind of tallies together. And it was an emerging markets commodity story as well, which is a little bit what we had last year.
So you think the main thing for the reason of underperformance is just outflows?
I mean, I think that's been a major contributing factor, because the majority of the fall has been in a de-rating. But we did have good earnings growth in the US, and the UK's earnings growth did lag. Now maybe that was because they weren't doing as many buybacks, so that obviously helped the US companies to kind of print good earnings growth, even if it wasn't actually profit growth. But I think there's been a broader impact of the sell-off, is that the UK market's just not as vibrant a market as it has been. So the outflows and the de-rating has had the consequence that that companies have looked a little bit more inwardly. So a good example is that if you look at M&A in the 2000s, we were net acquirers of businesses outside of the UK. Right. Whereas in the last decade, we've been acquired. It's been companies being bought out of the UK rather than us being net. So there's other elements where growth hasn't been as strong.
How do you, slight left turn, how do you feel whenever a company, and obviously it's, if a company from your portfolio were to get acquired, you're going to see a pop in the share price. Not to put words into your mouth, is a wee bit bittersweet sometimes, depending on the price, obviously, that you're losing. We have seen companies coming out of the UK index, which I think are world-class businesses. It's always, I suppose, bittersweet as a portfolio manager, because you're probably going to find another idea to replace that. So, double-edged sword, maybe.
I think so, and I think at the moment, because the valuations that we see in our companies are so low that you worry that something's going to get taken out at a 30 or 40% premium, but actually it's worth 70 or 80% more than the share price or more. I think, look, for me, it's not a big problem. What it does is it brings forward that upside, which is nice to have. We just book it, and I think it would be a problem if we then couldn't find an idea to replace it. But again, because the market is, I see, so attractive, we've got a long watch list, and there are opportunities to recycle that capital into other things that we similarly kind of see big upside in. So it's not a concern for me, but it is certainly, I think it should be a concern for kind of the UK market as a whole. And we should be thinking, what could government do, what could we do to kind of lift up valuations so that on a global stage our companies are better valued, and therefore can raise capital and can spend more on capital projects and can create jobs. There's kind of lots of good stuff that comes out of being at a higher valuation.
Sure. How much of a proportion of the UK, who owns the UK stock market? And what I mean by that is domestic investors versus overseas. I'm going to hazard a guess that the proportion of domestic has risen. Because if you're a global equity manager, probably looking around the world, the UK market has become easier to ignore, A, because it's falling as a proportion of your benchmark, and B, because we've had our own idiosyncratic issues as an economy, and we all know the economy is not the stock market, but if you're a global manager, it's probably easier to sort of look past, I guess. Do we know?
I've seen some stats that suggested that it outside of the UK owns more UK equities than people who live in the UK, but I wouldn't want to hang my hat on those statistics, because I don't know whether that was kind of looking at institutional or retail. I think the important thing to say is that our market is quite different in that investors can invest overseas with very low barriers. So if you live in the US and you want to invest outside, in a UK equity, you have to fill in 100 forms and you have to refill in those forms every year, whereas so there's a real strong emphasis on investing in US equities, as is the case in Australia and Canada. Whereas a UK investor, we kind of open our doors and say, go,
buy Nintendo or whatever. I don't know what I thought of Nintendo actually, but you can buy Microsoft. As long as you fill out your W-10, I mean, it's not massive barriers to entry.
You don't even have to fill it in, do you? It's only to get the tax.
Devies. Yeah. That's a fair point. I never thought. I didn't realise that. Do you think we should follow suit?
Yes.
I'm sorry. I'm asking. I'm asking UK equity manager.
UK equity manager says, yes, that we should invest more in UK equities. No, but I think that we have got ourselves in a situation where our current, our market is undervalued, and there are consequences for the economy as a result of that. And actually having a strong, vibrant UK domestic market, and you can see that if you look at market cap as a proportion of GDP, which has come down, whereas it's gone up for places like the US and Canada and Australia. And actually, I think there is some circularity to actually, if we could lift our market cap as a proportion of GDP, there would be knock-on benefits for the economy.
Brilliant.
Do you think,
and me.
Again, it's probably the wrong question to ask a UK income manager, but talking about share buybacks, do you think, across developed markets, we probably pay the highest level of dividend income. Do you think there should be a better blend of that, whether that's reinvesting more into businesses at arguably higher returns than are paid out, or do you think we should be a bit more relaxed on share buybacks? Because I was I don't know why, but I think when I started, share buybacks were frowned upon, and we'd always say, well, we'd much rather the cash so that we can do what we want with the dividends. But it is obviously supportive of share prices. What do you think?
Yeah, well, there's actually a lovely segue into a chart here's one I prepared earlier, which is if you go back to the 1930s, dividend has been a really important part of shareholder total return, and I think that's where the heritage and the history of the UK market placing such an emphasis on rewarding shareholders through a dividend rather than through buybacks and earnings growth it comes from. So that's why we do it, and we can talk about then whether it's a good idea. I think the reason that we're asking the question, particularly today, is that if we look at the last decade, so the 2010s and then the kind of 3 years after that, the proportion of total return from dividends was just kind of 20%, whereas actually the average looking back through the decades is 63%. So historically it's been really important. The last 15 years it's been less important, and so now we're sort of saying, oh well, actually is it is it right going forward? For me, the future, we can talk about why, but if we are going back to a world that looked a bit more like pre-GFC than post-GFC, and we've got interest rates going back to kind of normal levels, and we don't just have returns. So the last 15 years, if total return's not coming from dividend, it's coming more from either earnings growth or from re-rating. And I would say a lot of it's come from this kind of re-rating of markets, and that can't continue forever. So if we go back to a world where ratings stay the same or come down, don't go up any further, then actually dividend yield's going to be really important again, and income's going to come back to the fore. So I don't think that we should be messaging to companies to say, actually you have this kind of strong payout policy, we'd rather that you took some of that cash and bought back your own shares, albeit that there are some exceptional standouts where the company shares are so cheap that actually there is a compelling argument to say that buybacks in that situation are warranted in addition to dividend. And the last thing I'd say on that is there's some quite good evidence that company management that are forced to pay a dividend, it actually encourages good capital allocation decisions.
I was going to ask you about this. It just caught my eye in your most recent annual letter about this sweet spot, I think is the term that you use, of dividend payments between 2 and 8%. Can you talk a little bit about that? What your sort of research shows about companies that pay those sorts of levels of dividends and performance?
Yeah. Well, it was really interesting because it's something that I believed for a long time, but wanted to kind of back it up, which was, companies with a dividend yield of less than 2 are therefore in the most expensive part of the market. And you'd expect the most expensive part of the market to do a bit worse, perhaps because your starting point is higher. And then companies with a dividend yield of above 8-10%, you're getting into the kind of deep value territory, distress, and there are some fund managers who are really good at that, and they do outperform, but it's just a harder part of the market to do well in, because you've got companies that are, as you say, distressed and are in trouble. And so what was fascinating is when I asked SocGen to run it through their database of the last 40 years, and they looked at 3-year returns for all their stocks with a starting dividend yield in different kind of dividend yield categories, is that actually things that had a dividend yield between 2 and 8 were where you got kind of consistent good returns, but it was the most expensive mark, kind of 0 to 2, which had less, and then the kind of 8 to 10 and 10 plus, which had less again. So it just made sense, and I think a lot of income managers are swayed back to this kind of behavioural bias idea of they have this sort of mental accounting and bucketing, and they kind of go, we're going to have some stocks over here for capital growth, and we're going to have some stocks over here to deliver on our income target. And what they don't realise is they've just made their job twice as hard as actually if they just said every stock has to do some capital growth and every stock has to do income, and stayed inside the income sweet spot. Yeah, it's something I'm keen on.
First thing I'd say to you is lucky you've sort of had an idea of what you thought the data was going to show, and it actually worked. Whereas when I sit down to write something, I write it, think that I know the conclusion, see the data, and it's completely different. So I usually have to rip it up and start again. So lucky you. It's probably why I've not got a CFA and you do. Just on the
funny, Johnny's staying remarkably quiet, isn't he? His data obviously backs up his argument as well.
Just on the portfolio construction, because you've mentioned it a couple of times, Emma. Quite a systematic approach. Whenever I sit in front of a fund manager, the 2 questions I always sort of want to ask is about position sizing. How you do that, because I think that's really hard, and I think your hardest job is selling. Knowing when to sell, and I know you've got quite systematic approaches to both of those, so do you want to just tell us a little bit about how you think about that?
Yeah, no, thank you. I'm always happy to talk about my disciplines, because I think they're a little bit different, and I guess stepping back, why do we do it? Well, it's about creating a framework where we can make the best investment decisions, because as we said, they can be sometimes the most uncomfortable ones are the best decisions, and also for transparency, because I think in this day and age, you guys will know you're getting increasingly required to write down why did you pick Emma Mogford as a fund manager. You have to back up the argument, and you also want to have the confidence that when I outperform, I can do it again, right? Because I've got this process. So that's sort of why we do it. So position sizing, we position size in 1, 2, 3, 4, or 5% positions, which is relatively unusual. I've met fund managers before who have equally weighted portfolios, so they kind of do 33 best ideas all at 3%. I like that discipline, but I wanted to be able to have different levels of conviction, or actually it's more kind of probability of success in the portfolio, which is why we've got different sizes. But why have round weights? Well, our first big advantage as an active fund manager is that we can benefit from volatility. So if we think the intrinsic value of a share is X, then we know it's going to fluctuate around that price. And so the ability to top up when something falls, and the ability to kind of trim when it gets a bit overcooked in the short term is a great thing for us to benefit from. And it's also one of those ones where the decision's hard. So, let's take a 2% position. If it underperforms the market by 10%, falls below a 1.8% position in the portfolio, I'm immediately, thinking, okay, right, is this a situation where the investment case is unchanged, but it's just a share price fall and great opportunity for me to buy more shares at a cheaper price. But importantly, we're not asking a computer to rebalance the portfolio, because sometimes those reviews tell you something that you want to, that's important, that is challenging your investment thesis. And so I'd say that happened with Vodafone 2 years ago, and that exact example, fallen from 2% position to below 1.8. And actually we looked at kind of why that was, and it was violating a lot of the investment rationale, which was that returns would get back to in excess of the cost of capital. They kept pushing out the date when that was going to happen. CapEx kept going up. And so, coming to your second part of your question, which is having a sell discipline, we sell the whole position in that situation. So I think a lot of fund managers will fall into a trap of being anchored to a particular price. And I know in Vodafone's example, there was one analyst who was saying, but you wait till it gets back to £1.50, like you don't want to sell it today.
Is a round number.
Yeah, wait till you get back to £1.20, where you kind of, the shares today are sort of, back in the sort of 70s and 80s. I think it's so important to have that discipline where you just go, no, you know what, we can't bring ourselves to buy any more shares. And if we can't buy any more shares, then, we don't want to own any of them. And so we'll sell it. And then just final point on the kind of sell discipline, the other thing we do is every stock in the portfolio has got a minimum dividend yield of 2%, because we want to be in the income sweet spot. Yeah. And that means that we don't fall in love with our companies. So when the dividend yield goes below 2, and, likewise, there are probably other valuation metrics that kind of showing
some companies expensive. Are so easy to fall in love with.
They are. Well, so Diageo is an example of that.
I knew. Do you know? I was just thinking in my head that was his name coming out.
Yeah. So we sold it because the dividend yield fell below 2, and we were like, that's okay. We can pass that over to the growth managers, and they may make money out of it, but we can reinvest it into something, which is quality at a reasonable price rather than quality at a full price.
One of the difficult situations that we sort of find sometimes in private client land is where you've got a client who's made money from being compensated in stock, or has a huge amount of their overall wealth in one name. Because that anchoring is like on steroids. If only this thing gets back to £1 a share, then I'll sell half my stake. And I don't know what approach you both take, but I sit in front of these people and say, you have got to have a plan. Two things: one, have a plan. Two, accept that you are not going to nail this. You're not going to get the optimum outcome.
100%. I mean, case in point, I was speaking to someone yesterday who works for a US business and has a lot of wealth tied up in the business, in terms of employee shares over a period, and then it resets at the end of the year, and then it's if she's still there, it's high level compensation again. If you look at overall wealth in that company versus overall assets, probably 50% of her wealth is tied up in future pay. And relatively new client, but probably set up 6 months ago when that part of the US market was at much lower valuations, and the first quarter came and sold it down. And obviously the share price today, ready for the next chunk to be released, is probably double, maybe slightly more where it was. And it's that, oh goodness, I should have kept the old stake because it'd be worth a lot more. And I played it back and said, when we sold that stake, and I said to you, your holdings can be double the value, would you have been happy? And she went, yeah, of course I would. I went, well, there you are. This is part of your long-term planning, which is we need to continue the process until you've got a diversified portfolio away from a company you're not only employed by, but you've got 50% of your wealth in. So I do think you have to step outside, don't you? And however much you love that business, there are other very good businesses around the world as well.
That's about being disciplined, isn't it, and having a plan, as you say, and sticking.
I think putting a plan in place and sticking to it, and you can review the plan if you want, but ultimately it's to have a plan. I mean, going back to Dave's original point, the bigger challenge we have is around CGT positions, because not only have you got to...
It depends on the company.
Depends on the company, but say there is a big embedded CGT issue, you're not actually distributing the proceeds equally, are you? Because you've got a big tax position to pay on it, and it's then the client tends to look at it and go, well, if I don't think shares are going to fall more than 20% from here, or there's more than 20% upside in the other one, then that is the really hard position. Again, someone say it's a nice problem to have, but often it's a very stressful problem to have because clients go round and round in circles with it.
And then I think it just comes back to time horizon. You've just got to say, look, imagine yourself, in 10 years' time, in 20 years' time, like, what do you want your portfolio to look like then? And then the path to that.
How to get to that.
Yeah, exactly, because on a 1 year, 2 year basis, it's much, much harder to make those decisions.
Can you talk about individual names?
Yes, I can.
Brilliant. None of this is investment advice, of course, but Emma, blink twice if I should buy some for my PA portfolio. So the one that jumped out immediately.
He's got them all, hasn't he?
I'm going to have to keep my eyes really still.
BAE jumps out from the portfolio. Obviously, it's a stock that we've talked a bunch about with clients. I'm sure you two are the same. Obvious name that jumps out of the index, given sadly what's going on with the world. Do you want to talk a little bit about BAE and the opportunity that you see there?
Yeah, absolutely. And I think the first thing to say is that I think that this, while there was obviously a step up in defence spending last year and in the subsequently in the share price, I think it was up just under 70% in the 1 year numbers in 2022. So fantastic performance from the shares. I see this as the start of a longer term rise in spending, and that's not, it comes across very negative. I'm not trying to anticipate that war continues, but I think if we think about changing world power and world power balances, and I know you've talked a few weeks ago on this podcast about demographics, and I think that is so important, that actually is the rise of China as a defense superpower, in that how that plays out against the US and in the regions. Then you've got India actually rising not far behind China in terms of GDP. They've already overtaken the UK, and in a few years' time, could be sort of third in the league tables. It's about rising power and how that power is then protected, and people will build defence that gives them security. So it's not about anticipating we're going into a decade of conflicts, exactly. But we're going into a decade where people are going to re-establish world order, and that's going to require a bit more of
people are going to be more prepared to buy insurance against.
That's what it is. Yeah.
Well, we've talked before about the post-Cold War kind of safety boom that we've had in effect. Defence spending as a proportion of GDP has fallen in those 30-40 years. And we've had globalisation, which has been deflationary. So it's not hard to paint a picture of the world fracturing into two. The net benefits, the marginal gains from globalisation coming to an end, i.e. not being deflationary anymore, and the world splintering, and therefore countries having to spend more on on defence as a proportion of GDP. And I think that the one thing that did jump out at me is that the Germany moving to 2% of GDP spending on military defence was huge.
It's a big change.
It's a real sea change in their attitude
Yeah.
since the Second World War. So, the thesis is a pretty simple one. Defence spending globally is going up as a proportion of GDP and in absolute terms, and BAE, as one of the top 5 globally, probably stands to benefit from that.
And actually, we were lucky enough to listen to Tim Marshall, weren't we, at a recent event we were at, and he's written the Prisoners of Geography book, and the new one I think is Power of Geography. And as a recommendation, actually, I think anyone listening should read those books. They're absolutely phenomenal. But he spoke a lot about essentially why you have some of the issues you have in the Middle East, and why China potentially would look to take Taiwan at some stage. Although actually, I think when he spoke, he was one of the few academics that thinks that's less likely to happen now, post Russia going to Ukraine, because of the response that the world has seen from the West. But those 2 books go to explain in so much detail why you have these conflicts. He was phenomenal.
Really good, and I love how he just shows maps in a different way. It's funny if you turn a map upside down. And one picture sticks in my mind was him showing the Chinese, sea southwards, and a row of islands, being the Philippines and Japan, and it's this actually being a barrier, to them getting trade out and being able to access the rest of the world, because of this kind of row of islands that are owned by other nations, and how threatened they feel. And it's sort of hard, I think, living the other side of the world you look at the map and you sort of think, but there's huge chunks of ocean, and you sort of forget that actually from where they sit, they look out and there is actually quite a hard line.
And of course the one in the middle is Taiwan. But he talks a lot about invading Taiwan and how hard it would be, because you essentially have one beach, which is the only real landing strip, and then beyond it is very, very steep, a very steep mountainous area, which I had no idea about. But again, I learnt so much from his books. I think they're a fascinating read.
There's a book recommendation for you if you're going away on holiday.
2 book recommendations by both.
You on commission, mate.
I've got a signed version actually.
HOUSEBUILDERS, PERSIMMON. Beaten up quite badly. Pretty obvious reasons for that. Mortgage costs. PERSIMMON, I think the point that you made again in the annual letter was quite exposed to first-time buyers who tend to be a little bit more leveraged. So you want to talk a little bit about PERSIMMON, because that is it's still paying a chunky dividend, isn't it? It
is, yes. So they've taken they've cut the special, and they've sort of reset their dividend policy now, but it's still an attractive dividend yielding stock, and I think it's sort of hard. It is one of those examples where the news flow is pretty bad, and you have to, as an equity investor, say, right, so how does it get worse from here? And actually, where's the downside? And actually, if I can't build a case where there's significant downside, then maybe there's an opportunity in with a time frame of 3 to 5 years that actually we're looking back at this time as being kind of a real kind of crunch point of bad news, and maybe things will look better in the future, and that's the opportunity. I think if we think then about valuation, the whole sector is trading now at a discount to book. It's significantly cheaper than its sort of 10-year average. It's not quite back to GFC style lows, but you remember back in the GFC we had kind of emergency rights issues, and we had companies having to offload books of houses. Today we've got companies that have all got net cash positions. We've got a relatively undersupplied. With the last 3 years we haven't built as many houses as there's been demand for, so we're kind of going into this with a relatively kind of short supply book. So I think the question then is, how bad does the demand picture get with mortgages in the 6s? So your 2-year fixed today is kind of up there at 6 or a little above, and so for people refinancing, that's going to be a big headwind, and specifically for PERSIMMON, the first time buyers, that's going to cause a lot of people to question, is this the right time?
Is it worth it?
But I
Do we
think
6 is like a magic figure where you sort of, because it's round number, isn't it? People
Probably would have said the same at 5, wouldn't you? And it's blown through that.
I got my letter instantly from the
yeah?
HSBC yesterday in the post. Dear Mr. Henry, as interest rate, I'm on tracker mortgage.
Yeah.
As interest rates have gone up, your payment is moving to.
Thanks very much, guys.
yeah.
Cheers,
bottle of
Governor.
wine.
Cheers, Governor Bailey.
Yeah. Well, the market's pricing in 6.25 peak rates, isn't it?
Yeah.
March next year,
Yeah.
which seems very high.
It's a volume game there, Persimmon, isn't it? It's not
Yeah.
necessarily. I'm not sure the market's saying
Exactly.
that house prices have fallen 25%.
No.
But if the mortgage market tightens up and people generally, in the face of uncertainty, people decide not to do anything. Comes back to animal analogies, rabbit in the headlights, right?
Yeah.
So it doesn't take much. What do Persimmon normally sell? 10,000 houses a year, and if they sell 8,000 houses this year, that's probably 25% off their profits. And the share price is down what? Loads, but you know, you can sort of paint the picture. It's not necessarily the share price is very, very sensitive to what's activity in the housing market.
It's, yeah.
Both ways.
There's a lot of
At least
other
with house
aspects,
builders,
yeah.
you've got the land banks as sort of
So,
a floor
yeah.
in value.
So I think that
there.
this-
Yeah.
And land values. I've got a very close friend of mine, sort of brokers land sales and potential developers, and he said in terms of land values, you know, the price is going one way upwards still. It's so these land banks are worth a lot of money still.
Yeah, and I think also we forget, you know, actually the mortgage market is a bit healthier than the, sort of on the face of it, because you know the third of the UK households who own who have a mortgage and a home tend to be in the more wealthy deciles. So kind of 50% of mortgages are in the top 2 deciles, the top 20% of income levels. So actually, you know, the people who are going to be really hard hit by higher interest rates actually surprisingly are renters, because a lot of the rental market is buy to let, and they have interest only mortgages on those. So they're putting rents up, you know, a huge amount. Actually, I think for people who are remortgaging, or for people buying new homes, actually what we need to look at is the affordability relative to earnings. And let's not forget, a lot of people have seen wage growth in the last couple of years as well. I mean, wages are currently running at plus 6%. And so actually you can look at mortgage affordability, and it's still, you know, can be in the high 20s or low 30s. It can be at a level where people can say, oh, actually, I still want to own my own home. This is still the right decision for me in the long term. And you know, at some point interest rates may come down. Mortgages may not be at 6% forever.
No.
So
I guess that's, I mean, a really valid point. I guess the calculation still, the way to think of it is, if you were buying said house in a street with, let's say, a 20% deposit, 10-15% deposit, versus what would it cost to rent that, and then work out, you know, look at the calculation of the mortgage repayment versus what the rent would be, and how different those two are. And I'm presuming it's still cheaper to buy and pay a repayment even at 6% than it is to rent the equivalent. Certainly would be in some areas. Definitely.
It's going to vary, isn't it?
Yeah.
What to think about?
We're so British.
Yeah.
We talk. It feels like we talk about housing every single week. We're
Well,
obsessed.
the economy's based on housing, isn't it? That's the
Yeah.
problem.
Well, yeah. I mean, that's why I'm astonished rates have got to this high, because the Bank of England have always been very vocal about not
Crushing
career
the
and that.
housing industry,
Well,
yeah.
whether they are or not, we'll find out, I guess. Relatively new addition to the portfolio, I think, next.
Yeah, that's right, yeah.
Do you want to talk us through that one a little bit? It's your favourite company, John, isn't it?
Wonderfully managed business next.
Can we talk about where
not
you
my favourite
thought
sector.
about buying them and where Emma did buy them?
Think about doing a lot of things. I'm thinking about it.
Don't need to play at every ball, easy.
No, exactly right, David.
Well, that's right. You know, it went from £85 to £45, which, you know, in the space of sort of 12 months, 18 months. So it's quite amazing sometimes when you reflect on a quality business with quality management, you know, selling clothes, you know, they're a little bit cyclical, but they're not kind of super cyclical. It's sort of just quite amazing actually to reflect that equity markets can have that sort of volatility.
So talk me through that process, presumably, because you run quite a tight list, right, of stocks, concentrated portfolio. You have presumably a subs bench of names, price target potentially, margin of safety, and then it you know, sort of come on, you get substitute, come on and add
position. And I think so you've got the sub-spend, but you've also got quality stocks that we'd love to own in the future, but they're just a long way away from the valuation. And I would say Next was like that 18 months ago, and it was that fall back into kind of quality at a reasonable price, which is what we're looking for, that made it jump out to us. And then on deeper dive into looking at the fundamentals, you realise that actually through the pandemic there was actually a destocking of clothing. People actually bought less clothes than they did in a typical year pre-pandemic. They destocked their wardrobe, and it left us feeling that consensus were looking at sort of high single-digit falls in sales this year because of the cost of living crisis, and we were saying, actually we think that's probably too bearish. And what's come out in the last few weeks is that Next themselves had guidance for full price sales to fall 5%, and they've actually had to come out and say, well, actually in the last couple of months we've been running at +9 because the weather's been nice, but also because of this wage growth point, which is that actually as people have seen their wages go up, they've gone into spending money on clothes.
We were in Greece last week and been through the airports a couple of times, and to your point about anecdata, it's always very dangerous, but the airports are packed. Airports are packed, and when you're going on holiday, you need new holiday clothes. It's probably not a surprise they're doing quite well.
Probably part of it is taking market share as well, isn't it? From online businesses that have fallen over.
Well, the capital allocation is so good as well, isn't it? We talked about buybacks earlier, but Lord Wolfson, who's run it for years, he's really good at deciding to pay a dividend or do a buyback, depending on where he thinks the share price is.
Exactly.
And then he's bought out, a few brands out of insolvency in the post-pandemic period. So Jules, Made.com. Made.com had a market cap of 800 million or something, and he bought it for 3 million. He bought the intellectual property and the brands and everything in the stock for 3 million, which is extraordinary.
And I think he's also had that kind of long-term foresight to see that what the consumer wants is a multi-brand platform. They want to be sure about their next day delivery, they want returns to be easy, they want the app to be user-friendly, but they don't want just one brand, they want to have access to lots of brands. And so by the kind of the total platform, I think that they've grown very well, but they've also got this huge runway for growth as they continue to add brands into that.
Presumably one of the biggest risks is the CEO retiring, though. I know there's supposedly he says the market would be the last to know who the successor is, but apparently there is a known successor who's
sounds like the next season of Succession's being
it
written.
Does. Dave's addicted.
Spoiler alert, it's going to be Macaulay Culkin's wee brother from Sorry, we're getting on towards wrapping up here, and there's a couple of bits I really wanted to ask you, if that's okay. Please. Sadly, we're not going to get to the fact today that Nigel Farage has been sacked as a client by Coutts.
Taken on by NatWest,
which I'm as devastated about as anyone. Just final thing. Listen, I'm just writing something at the minute that I'm gonna put out on Tuesday. But all sensible investment strategies go through periods of underperformance, and I'm always curious when speaking with professional investors, what do you find sort of helps during those periods where your factor or your style of investing is maybe a wee bit out of favour, because that is an inevitability for all of us.
Well, I would say that having studied, met all the great fund managers out there, no two have been alike in their approach and process.
You've met one more now today.
It's rare to find two with the kind of the same process and philosophy, but what they were all good at is knowing themselves and knowing what their strengths were, and then sticking to it through the thick and thin. So I guess my advice to myself and to anyone else is just to know your strengths and to have that conviction that you stick to it when the market kind of tells you you're wrong, and I think particularly for me what's been helpful is to try and find evidence to back up my thoughts around the kind of the income sweet spot, and then that's just given me that kind of confidence to say, okay, there'll be times in the market where all the expensive stuff with a dividend yield of less than 2 is going up, and and that's certainly happened, but that's okay, because I know that over the long term actually kind of quality at a reasonable price has got this sort of evidential underpin, and it works. works in certain market conditions. So the worst thing I can do is sort of try and chase a different style, which is not what I'm good at.
Yeah, chase the plastic bag as it gets blown about in the air. Never catch it.
So it feels like,
Emma, thank you so much for coming on.
No, thank you.
Hopefully we'll get you on again soon at some stage. Gentlemen, thank you very much.
That was excellent. Thank you.
Thank you for joining us, folks. We'll be back in a fortnight, isn't it? Back again in a fortnight. As usual, if you've got any questions, let me know by email. Otherwise, we look forward to seeing you again. Thank you.